All right, so welcome to Financial Accounting by Samuel Ibanda. Today we want to expound on the accounting equation as a question that came through from one of you. And like I said earlier on, the accounting equation is a build up on our previous topics on double entry. Basically, the accounting equation comes in to show us how each of the different transactions are affected by the accounting equation. So that is what exactly, and that's why they use the accounting equation. So to demonstrate this, I want to use one question here. Let's try to use this. So when it comes to the accounting equation, I want basically to find a question here that I can basically use to show you exactly how a transaction can be affected by the accounting equation. We have something here. Okay, this is this does not have papers as we should have. Very similar. Okay. Okay. So this paper does not have, so I'll just create a question and then I'll be able to build it up from there. So let's get back to our Excel here. So let's say Jen started a business with 300,000 cash and a vehicle worthy 2 million shillings. Jen started a business with 300,000 cash and a vehicle 2 million shilling. Now, one thing that we understand is that when Jen is starting a business, whatever she starts with is regarded to as capital. So what she contributes to the business is a capital. So the 300,000 cash and the 2 million for the vehicle is basically regarded as capital to the business. So we may want to represent this on the accounting equation. We may want to represent this on the accounting equation. Now, whenever we say the accounting equation, this is a standard equation, which says that when you get your assets, these should always equal to liabilities plus owner's equity. So your assets will always equal to liabilities plus owner's equity. Now, right now, I believe that we understand what assets are. And by assets, we know that assets can either be fixed assets or current assets. Or sometimes the fixed assets are also called non-current assets, or we call them long-term assets. And if it's fixed or long-term or non-current, means it will exist for 12 months and above. If it is current, it will be 12 months and below. And we know some of the examples. We know that when it comes to the fixed assets, we have the motor vehicles, we have fan fittings, we have land and buildings, and so on. And also to note that it's not that every time you see land and building, you classify that under your non-current assets. Why? Because there are some organizations like real estate companies that deal in land and buildings, and these are their stock. So this is their stock, this is their inventory. So you find that for them, this is what they deal in. So it's not fixed assets to them. Yes, they may have fixed assets under the category of land and building, but they also have land and building that they actually sell, buy and sell. So that would be under their current assets. What's part of their kind of, say, stock. And of course, then the current assets, we know them: the cash, the bank, the prepayments. We have inventory, treasury bills, and so on. Even short-term investments would also be classified under current assets. Now, liabilities, we know that these are obligations, okay, short-term and long-term, and then owner's equity. This is owner's contribution to the business. So how do we represent such a transaction on the accounting equation? So we are saying that Jen started a business with 300,000 cash and a vehicle worth 2 million shilling. Now, the first thing you're supposed to do is to determine, to understand in this statement, in this transaction, what is an asset? Do we have an asset in this transaction? Do we have a liability in this transaction? Do we have capital in this transaction? Now, as we can see, we have a current asset, which is cash, but this time it is coming into the business. We also have a vehicle, which is a fixed asset, a non-current asset, which is also coming to the business. But since Jen is starting her business, we also regard these two items as capital. So when we are feeding them into our accounting equation, what we are basically going to do is, when it comes to here, we're going to represent our accounting equation. So on the side of assets, I'll try to expand this better. Do this. Okay, so on the side of assets, I have cash to the tune of 300,000. I also have the vehicle that is coming through, worthy 2 million. So that is what I basically have. On the side of liabilities, I don't have any liability in this statement. Liabilities are usually obligations to the business, and liabilities can also be current and non-current liabilities. In the same way, the parameters of determining what is current and what is non-current is based on how long these liabilities will stay for the business. Liabilities that will be paid between 0 to 12 months are called current liabilities, and this could be short-term loans. Basically, this could also be payables. Accounts payable are current liabilities. Now, liabilities that are going to be paid after a period of 12 months are usually long-term liabilities, non-current liabilities. Some of the examples we could have could be long-term loans, 5-year loan, 2-year loans, but we could also have lease payments and so on. Even debentures could be classified under liabilities, okay? So that is very important here. So in this transaction, we don't have any liability. So here we record 0. We basically don't have any aspect. Now, under owner's equity, we record only aspects of owner's contribution to the business, or transactions that are between the owner and the business. So for this transaction specifically, we have Jen starting a business with 300 and cash and a vehicle worth 2 million. In total, Jen is starting a business of capital worth 2.3, which is the summation of the 300 and the 2 million. So when you add these two things here, the 300 plus 2 million, this will definitely give you total of 2.3. This side will also give you 2.3 because we're just adding this 2.3 plus nothing down, which makes our equation balance. So as we can see here, our equation is balancing because our assets of 2.3 plus liabilities, which is 0, as we have seen. Our assets is equal to liabilities, which is 0 plus 2.3. So 2.3 is equal to 2.3. So that's how the accounting equation looks like. Now, I'm going to do another transaction, then I'm going to ask you if you understand this, and then you'll be able to ask me, especially for my friend Stella, who raised this as a question. But before that, just give me a moment. So we have done transaction 1. I believe that you've been able to reflect on this transaction 1. And I hope that you're trying to pick something. So I'm going to do another transaction, and then from there, I'm going to ask you questions, or you're going to ask me questions. So maybe this was on 1st September. So let's do something on 2nd September. So on the 2nd day, Jen we can say on the 2nd day, Jen bought some raw materials for her business worthy 100,000. Okay, so Jen bought some raw materials for her business worthy 100,000. So what we basically do again, we reinstate our accounting equation as it is. So assets is equal to liabilities plus owner's equity. So we have this side and this other side. Now the question again to ask ourselves, in this transaction, do we have any asset? Do we have any liability? Do we have any owner's equity? Now, one, we don't have any owner's equity because the owner has not contributed money to the business in this transaction. Okay, there's nothing to do with contribution of capital like it was in the first transaction. Now, when it comes to liabilities, the owner does not have any liability in this transaction. If they had bought this on credit, then there would be a liability called accounts payable, but there's no liability of the same. So if that is the scenario at hand, means that what we have here are assets. So we have two assets, and the two assets we have that are being affected, one, the raw materials. Raw materials are part of the assets, and these are current assets. Raw materials follow under the category of inventory. Well, the 100,000 that we are using to buy this inventory is also being affected. The 100,000 is basically cash. Our cash is reducing by 100,000 as our inventory is increasing. So what that means is that we are going to have our cash. Now, instead of our cash being 300,000, it's going to be 200,000 because we've used 100,000. And we're going to have another asset called inventory coming in of worth 100,000. And then we shall have a vehicle which is worth 2 million. We have a vehicle which is worth 2 million. Now, like we said, there is no liability for capital or for owner's equity. We shall just carry what is above because there has not been any change and record it there. So at the end of the day, when we add these two sides, 200 plus 100 plus 2 million gives us 2.3. Which is exactly the same 2.3 that we have here, as we see here. So what this means is that we've actually been able to have our accounting equation balance. So at this level, Stella, do you have something that confuses you on this process? Or any other participant that is following through this live? Do you have any challenge regards to the accounting equation as per where we have reached?
Samuel, so far so good. However, during the example, the previous video that you shared, it had like many accounts coming in, opening up different accounts. And this time around, you're not doing it. I don't know whether this is a beta version. I don't know whether what I'm explaining is.
Okay, I do understand. Now, what must have happened in the other example that you went through is that I was doing two things concurrently. I was doing concurrently the aspect of preparing ledgers as well as doing the accounting. If they ask you to do the accounting equation, you specifically do this. You don't have to do the ledgers. But for the videos, basically I was trying to show you what do you do in the accounting equation and what do you do in the ledgers. Is that helpful?
I understand.
Yes.
Thank you.
You're welcome. So to the rest of the other participants, do you have any challenge when it comes to this? Or any of you who went through the respective videos? Do you have any challenge in regards to the accounting equation as a topic? Or any other topic that you might have a challenge to?
Not really. We've been following.
Okay, fine, thanks. So I'm going to proceed and I'm going to comment on one thing and then we'll be able to jump onto something else. So what I would encourage you that given the fact that Stella have given you an overview of this, I would encourage you to go back and rewatch that video because it encompasses different other examples on the same. But I just want to do something one more and then we can proceed on what I want to share with you today.
Okay, Samuel, I wanted to ask, is it possible if before you go on today's work, the examples that you've given so far, the equations, can we try to put them in their respective ledgers?
It's okay. So let me do another transaction here. So the other transaction I'm doing on that date, Jen paid rent worthy 50,000 for kiosk space using cash. So Jen proceeds to make this transaction. Again, what we do is reinstate our accounting equation as it is. We put it there. We we start now with our cash. Now our cash that was 300,000 reduced 200,000 in the second equation. Now, since we are still using cash here, our cash is going to reduce. Our cash is going to reduce. It's going to come to 150,000 because cash is being affected by this transaction. The same thing is going to happen. Our inventory is going to remain the same. So inventory remains the same, and inventory that is 100,000. Then the vehicle is also not changing. It's going to remain 200,000, 2 million, sorry. It's 2 million. In this transaction, do we have any liability? We still don't have any liability because we have bought everything on using cash. So our liabilities are 0. Now, owner's equity. Do we have anything to own? Yes, we have capital that we've carried on from here, which is capital worthy 2.3. Now, we have seen that the only effect that we have made is on cash. So what happens with rent? Now, one of the things that we have to understand is that we have what we call elements of financial statements. We have what we call elements of financial statements. And these elements are the assets, the liabilities, the owner's equity. Okay. And then we have income and expenses. This is what we have. These are our elements of financial statements. Now, the accounting equation specifically looks at these first 3: assets, liabilities, and owner's equity. And these are the aspects that also go into what we call our statement of financial position. Statement of financial position. So basically, the accounting equation is a representation of how transactions affect the balance sheet. So the income and expenses, these go to the statement of comprehensive income. Which sometimes we call the profit and loss account or the income statement. Now, it's also good to note that these 2 financial statements, the statement of financial position and the statement of comprehensive income, have a relationship between the 2. They have relationship between the 2. And the relationship between the 2 is that after you have gotten the profit or loss in the statement of comprehensive income, you transfer this to the statement of financial position under your equity. And that's why when we are doing our owner's equity, we have an item that is called, after we have capital, we also have items like retained earnings. So these retained earnings are basically, the word retained earnings is also, sometimes we call it accumulated profits. Retained earnings, these are usually profits from the previous financial years that the organization has not distributed out to the owners. So they have kept it in the business. So every time we get a profit in the statement of comprehensive income, we transfer that value, a profit or loss, to our retained earnings. Now, why am I saying so? Is that in this transaction, we may not have rent as part of either assets or liabilities owner's equity, but rent falls within the statement of comprehensive income, which is represented by a single item called retained earnings. The retained earnings is just the net of revenue minus expenses that we take to the balance sheet. And that's how the statement of financial position relates with the statement of comprehensive income. So these financial statements are interrelated. So because they are interrelated, when we are looking at the accounting equation and we have an expense in one of our transactions, that is handled under the category of owner's equity. The same thing also happens when we have an income. If we have an income, it is also recognized under that aspect of owner's equity because we don't have expenses anywhere in our accounting equation. So it means that this rent of 50,000, we are going to come here and say retained earnings, because that is the name that is in the balance sheet. And we're going to say equals minus 50,000. Retained earnings equals minus 50,000. That is what we are going to record. So what that means is when we add this 150 plus 100 plus this is going to give us 2,250,000. When we come and do this 2.3 minus 50,000, we are going to get 2,250,000. So we're going to get a very similar amount like the one we have this side. So this is what how we recognize an expense and revenue on this aspect. Let me just do one more where we have a revenue. Let's say on today, 4th of September, Jen sold goods worthy, maybe let's say 350,000 to Samuel on credit. So Jen has sold goods worth 350,000 to Samuel on credit. How do we represent this on our accounting equation? We still come and restate our accounting equation. The next question we ask ourselves, in this transaction, what is the asset? Do we have an asset in this transaction? Do we have a liability in this transaction? Does this transaction affect our owner's equity? Now, I'll first start with the liabilities, tick off. We don't have any liability here because liabilities only come in when it is us, the business, that have an obligation to pay. So we have not bought goods on credit. We have not gotten a new loan. That's only the time when we have liabilities coming in. Although we've sold to Samuel on credit, that doesn't mean that we have a liability. The liability is to Samuel, is not to the business. The liability is to the customer. Samuel, in his books, we are liability to him. But to us, Samuel is an asset. And how is he an asset? Samuel is an accounts receivable, which sometimes we call debtor. Samuel is a debtor to our business. The person we've sold to on credit is regarded as a debtor. And debtors are assets, and specifically recorded under current assets. So that is what happens. So if that is the case, this is what we're going to do. you're going to come and record. Now, in most cases, whenever we are doing the accounting equation, we have to first base on the previous transactions, okay? Because our accounting equation goes on building up. Doesn't mean that we just do an accounting equation for one transaction. We keep on building up from previous transactions. So we look at the previous transaction and see how they are affected, and then include the new transactions that are coming through. So the first thing is, I'll look at and say, is my cash affected? I'll say no. Why? Because we've sold goods on credit, so there is no cash payment. My inventory, is it affected? Now, in this case, we'll assume that our inventory has remained the same, okay? If they had told us about inventory, then we'd be able to go ahead to adjust that. So we assume that this remains the same. The vehicle, is it affected? No, it remained the same. What has been what new asset has come in? It's accounts receivable. The new asset that has come in is called accounts receivable. And how much is this? It's 350,000. Is 350,000. Is there a liability? No, we still have zero liability. Owner's equity. When it comes to owner's equity, you always ask yourself, what was there the previous period? We had capital. So we had capital of 2.3. Is it changing? No, it's not changing because the owner is not contributing any amount to the business at this level. Your question should be, retained earnings, do they remain the same? We had negative 50,000. Are the retained earnings remaining the same? It is not true that they are remaining the same. Why? Because this transaction of Jen sold goods worth 350,000 to someone on credit, it has an aspect of revenue. It has an aspect of income. And like I said, that whenever we have income and revenue and expenses, whenever we have income and expenses in a transaction, then that transaction will affect the owner's equity and will affect the retained earnings item. So revenue or income affects the retained earnings positively. Expenses affect the retained earnings negatively. And that is why in the previous transaction here, we recorded our retained earnings as negative 50,000. So that means that in this transaction specifically, our so-called retained earnings are going to have a plus of 350,000. So I'll just copy my retained earnings here. But this 50,000 is going to be added. We are going to add a 350,000 positive because this is revenue. So when you add negative 50,000 plus 350,000, you basically remain with how much? You remain with 300,000. You're going to remain with 300,000. That's what you're going to remain with. So after we have done that, we're now going to add up our information here and see if we can come to an equation balancing. So 150 plus 100,000 plus 200,000 plus 350,000. Sorry, I didn't add, this is 2 million. This is 2 million. So it gets you 2.6 million. This is 2.3 plus 300,000, which gives me also 2.6. So my accounting equation is balanced. So I've gotten this side, this amount, and I've also gotten the same thing. This other side, a similar amount. So at this level, to my colleagues that are watching this live, do you have any question up to this level? Especially my friend Stera. So I can be able to expound on that.
Me, I'm okay.
Okay. Do we have any other person who was challenged on this, or we are all fine? Silence means we are all fine. In case you have a challenge, please bring it up. The reason why is because we use these classes, especially the classes we hold in the middle of our going through the videos, to go back into what we have studied. And then I'm able to expound, I'm able to answer any questions that we might have. So it's very good for you to utilize the opportunity where you don't understand. Now, the video.
Question.
Please, 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 please.
So I have an understanding on retained earnings, but I'm seeking clarity from you. Why
Please.
is it that the expenses we are recognizing them as retained earnings? Is it to reduce on the because I assume I stand to be corrected that retained earnings, let's say maybe are the profits for the organization, additional money for the organization. So why is it that we are coming in to reduce those profits by the expenses?
That is true, because definitely expenses reduce our profits. The more expenses you have in your income statement, the lower the profit is.
Yes.
So here we are trying to look at it from the end perspective. We are trying to affect our retained earnings as it would have been if we are doing these things from the income statement.
Sure. Okay.
So that's why for revenue, because revenue increases your profits. That's why for revenue, we added it.
Yes.
When it comes to the retained earnings, it was a negative.
Yes.
And when we're trying to add the revenue of the 350, we just basically got the net, because that is our interest here.
Okay.
Yeah. So I would encourage anyone who has not gone through the video for the accounting equation to basically go through that recording. And like I said, one, I want to say that we have a very limited time between now and the exam. If you still see a lot of time, I want to tell you that we have a very limited time, because I've taught this paper for a very period of time and I understand what coverage means. So I'm glad that most of you have been able to make the posts on these papers. So I want us to do a fast run through the videos. Once I share the videos with you, let's make sure that we go through them, so that when we have this class, it's not for us to go through something that is in the video, rather it is to seek clarification and answer, just like the way this question on accounting equation has come up. So to those that joined in a little later, this class, like I said, is basically for me to expound on what you have gone through and you need more guidance on. So one of you brought up the issue of the accounting equation. She said she was totally confused with everything that was in the video. So I felt I should give a fresh overview of this. So at this point in time, I want to ask, before I proceed, let me just try to conclude something small. And then as you prepare that question. Now, one thing that you need to understand is that from the accounting equation, we can best be able to draw up our statement of financial position, which is also called our balance sheet. And that is one of the things that the examiner sometimes will ask when they provide you with the accounting equation. They may ask you to draw up the statement of financial position, which is also called the balance sheet. As we know very well at this point in time, maybe you have gone through that, but as we proceed, we shall be able to even expound more. We know that if we are looking at Jenny's statement of financial position, if we are drawing up Jenny's statement of financial position, which is also the balance sheet, we usually look at assets, and we also look at liabilities, And then we also look at equity. Like I said, this is a representation, the accounting equation is a representation of the balance sheet. Okay, it's just now the difference in format. So it means that in our assets, we usually have, we usually start with non-current assets. So for Jane's case, the only non-current asset that Jane has is what? Is vehicle. So I'll bring here, and I've explained that non-current assets are those that last for a period of more than 12 months. So Jane has 2 million. So I'll just put this 2 million here. Okay, so 2 million. And there's no any other. So we move to, you can get your total non-current asset, but since we have one item, we shall just proceed with that. So we have current assets. So the current assets that we have for our question here, we have inventory of 100, vehicle this. These are all current assets. So I'll just pick them the way they are. So I'll put this here. Also carry this here. Okay, so I'll do this. So these are my current assets. I can get my total current assets.
The vehicle still appears under both.
Okay, let's remove it. Thank you. Total current assets. I think I left out cash. We had some cash. Supposed to carry cash, which is 150. Okay. Supposed to be cash, not vehicle. 150,000. So the total current assets here, when you add them up, this gives you 600. So our total assets, looking at the fixed and non-current, okay, basically the fixed and the current, or the non-current and current will give us the 2 million. This plus this, which is the 2.6 right there. So liabilities, we didn't have any liabilities. So it means that there's nothing to be recorded, just like the way it is there. Equity, we have these items, capital and retained earnings, and I'll just copy them the way they are there. So when you add total equity, this will be summation of these two, which is that. That one you can press it on your calculator. I encourage everyone who is for this paper to get a calculator. Myself, I use Excel because of the learning mode, but you should be able to get yourself a calculator that allows you to calculate these things. Also, to get used to your calculator, don't just buy a calculator for the exam. Make sure that you get used to your calculator so that it is easier for you. So here we later get our total equity plus liabilities and liabilities. Which is still 2.6. So you can see that our balance sheet has actually balanced. We have the total assets 2.6 and the total equity and liabilities 2.6. Let's just see, just in case we had the liability. Let me just try to do demonstrate for you. Maybe this will be much easier. So let's assume that on the same day, 4th September, Jen took a loan of 10 million shillings from the bank to be paid in 3 years. Okay, to be paid in 3 years. So if you have such a transaction, if you want to represent this on accounting equation, what we are going to basically do is I'm going to still restate this here. And I'm now going to ask myself, this 10 million loan from the bank, does it have any asset in it? Does it have a liability? Does it have owner's equity? Now, it doesn't have an owner's equity because we are not seeing an amount of money being contributed by the owner. There is no liability as per se. Here, do we have a liability? Yes, we have a liability. What's the liability? Is the long-term loan. Do we have an asset? We have a new asset that is coming in. When the bank gives us money in terms of a loan, this money comes to us, okay, as the business. So what we're going to record here is our cash. Is it being affected? Now, our cash is going to remain the same, but what is going to happen is I'm going to have a bank amount of 10 million. Friends that work in the bank will agree with me that whenever the bank is giving you a loan, it will credit your account. So this money is at the bank from our assumption here, okay? This money will not come into cash, it will come through the bank. So we'll record it as bank 10 million. Inventory, I'll just pick it as it is, it remains the same. The vehicle remains the same. Just add more space here. Okay. And vehicle 2 million. Accounts receivable 350,000. Now, I don't have any other asset coming in here, so I'll move to liabilities. Liabilities, there was nothing previously, so I'll just record long-term loan as a bank loan of 10 million. And after the 10 million, I'll just come here. Owner's equity 2.3, retained earnings remain the same, unchanged. So let's try to add. So this is 150,000 plus 10 million plus 100,000 plus 2 million plus 350,000. This guy has not yet paid. So it gets us 12.6. The liabilities, it is 10 million. There's only one item there. This is 10 million. Retained earnings remains 2.6. So as we can see, the 12 million, which is our assets, is equal to 10 million, which is liabilities plus owner's equity. So our accounting equation has been balanced here. So if I just want to update my statement of financial position with the loan, what I'll just come here, I'll just say bank loan, 10 million. So total equity plus liabilities, I'll get a 2.6 and add the 10 million, which gives me 12.6. So here I'll have 12.6. And I'll also go ahead and update my current assets. My current assets will also have a new item called bank. We'll have a new item called bank of 10 million. So this will increase my total current assets, give me 12.6 here and 12.6 here, as you can see. So that is how we have our equity equation represented on our balance sheet. And that is one of the essences of the accounting equation. For small businesses, once they have an accounting equation, they can be able to formulate their balance sheet, as we can see here. So, as per now, when it comes to transferring items from the accounting equation to the final statement of financial position, does any one of you have any issue? Is there anything that confuses? Stella, your microphone is unmute. Do you have a question? Or you just...
No, I'm okay. I just forgot to unmute.
Okay. Okay, fine. Thank you. So I believe that everyone is okay with this.
Okay, Samuel, I have a question.
Please, Sarah.
My question is with liabilities. You see, when you get a loan from the bank, they will give you 10 million, but there is something they call the interest. So for us, we are having the current asset of 10 million, but as we are paying off this loan, the liability, this money will have to increase with the 10 million plus the interest. I don't know.
Okay, thank you very much for bringing that question. And I believe that it happens in reality. So for this, we're trying to look at the initial process of the 10 million, because interest is usually, say, annual. And sometimes you cascade this down into monthly in terms of what is your monthly interest. Now, before we finish a month, we don't recognize the interest. Now, we recognize interest after the period has elapsed. Let's say if 1 month has elapsed, then we recognize the interest for that period. So if it was the case that maybe a period has elapsed and we are recognizing the interest, would come and affect our retained earnings, because interest is an expense. So the interest will affect our retained earnings negatively. Now, the question will also be, what are we using to pay this interest? Are we paying this interest? Is it being deducted off our bank directly? Then we shall be able to adjust our bank accordingly. In case this interest is not paid immediately at that point in time, since if at all maybe we pay it annually, for the 1 month we shall include a liability here called interest payable, which we shall also include within our balance sheet as interest payable as the time proceeds through. So that's how we handle the dynamics of interest. But as per now, when you get the loan of 10 million, as of today, in recognition of your books, you recognize the 10 million as it is. The interest will be recognized as and when the period elapses to which the interest relates to. Is that okay?
Yes.
Okay, that yes seems like there's something that you may be not clear.
Yeah, I'll get there.
Yes, you'll get there, because we look at other aspects of that involve interest for you to best appreciate that. But for today, for matters of the accounting equation, I think we can leave it at this as you continue to appreciate other aspects. All right, thanks very much. Any other question? Okay, if there is no any other question, I want now to comment on the ledgers, the double entry as requested by Stella. And what I'm going to basically do is I'm going to give you what to debit and what to credit. I believe that right now you know how to draw up a ledger, okay? Now, I want to start with the first transaction where they're telling us that Jane started a business with 300 cash and a vehicle worth 2 million. Now we have seen that in the accounting inclusion, we have cash 300,000, vehicle 2 million, and capital 2.3. And what I said here is that this is how it affects the accounting inclusion, but how would it be within the ledgers? And that's the same how one of the videos is prepared. Now, when you're recording aspects, when you're recording transactions in the ledgers, we follow what is called the double entry principle. And the double entry principle says that for every debit and credit, for every debit, we should have a corresponding credit. Basically, every transaction has a dual effect onto the accounts of the business. In terms of value. Now, if they're saying Jane started a business with 300 cash and a vehicle 2 million, we debit cash with a 300,000. We also go on to debit vehicle with a 2 million. After we have done that, we go on to credit our capital with 2.3. Because in total, Jane has contributed capital of 2.3. Capital can either be in cash or it can also be in assets. So this is the double entry for this transaction. Now, what I say about double entry, that every transaction will have a debit and credit. Here we have two debits, but it's just that they are split into two. We have a 300 and then we have 2 million. So the 300 plus 2 million gives you 2.3. So in total, we have debited to the tune of 2.3, and we have also had capital to the tune of 2.3. So that is why we are saying the double entry principle has been fulfilled. If you want to put, now this is a demonstration in terms of debit credit. It means that if you're doing the ledgers, you just draw up your ledgers accordingly as it is. And I believe that right now, all of us know how to draw up our ledgers for those that have gone through the videos. So I'll have my cash account. And I'll also have my vehicle account, which I can put here. And this can be my vehicle account. And I can also have my capital account. So if I say debit cash, I'll come here on that day, 1st of September. I'll say capital. Now again, in the ledger, I'll not say cash. I'll say the alternative account. I'll put 300,000 here. I'll come to the vehicle, still on the same day, 1st September. I'll save capital. I'll not again save vehicle because I can't record vehicle in the same account of vehicle. So I record using the alternative account so that in case somebody wants to trace that vehicle where it came from, they can easily go to the other account. Then in capital, what I'll do, I'll break up the two amounts. Capital I credit, so I'll come here and say cash of 300,000, and I also say capital of, no, sorry, it's not cap, this is vehicle of 2.3, 2 million, sorry. So like that. So that is how my transactions will actually be in my ledgers. Okay. So that will proceed as like continuously. Even when I get to here, where Jen bought some raw materials for her business, in the same way, I'll look for the two double entries. What am I debiting? I'm debiting inventory. So I can open up my inventory account and on the debit side, record it. With how much? With 100,000. What am I crediting? I'm crediting cash because they didn't tell me they bought this on credit. So this is on cash. So if, for example, I already have a cash account, I'll not open it up. I'll just come to the cash account and say raw material on the credit side, since I'm crediting cash, and record the 100,000 right there. You don't open up again a fresh account if you already have. So inventory account, that one you open it up and record it on the debit side. If I'm coming to Jen paid rent worth 50,000 for the kiosk space using cash, I'll come and debit my rent. Whenever expenses are increasing, we debit them. And I'll debit with the same amount, which is 50,000. What shall I credit with? I'll credit cash.
Somewhere up there, I'm saying cash should be 200,000, not 100,000.
Where?
No, on a second, I'm saying cash of 200,000, then inventory of 100K. There.
You're saying cash of 100,000?
Cash should be 200,000, then inventory 100,000, because initially she had cash of 300K.
Okay. I wish to explain something small here.
Okay.
This is the accounting equation, and that principle works for the accounting equation. And that's why we have 200,000 here, because cash was reducing from 300,000 to 200,000 to be to have what we have here, and inventory was freshly 100,000. Now, when we come to the double entry, when we come to the T accounts, we look at the effect of the transaction on the account, not what is remaining. That is why for inventory, we said we debit inventory with 100,000 and credit cash with 100,000, because cash is being affected by this transaction by only 100,000 as the effect on cash for this transaction specifically. So for the double entries, we look at the effect on the account, the effect of the transaction on the account. So that is why you cannot have 100,000 here and have 200,000 here, because in that case, your double entry wouldn't have, there's no double entry there. Like in terms of this value should equal to this value in terms of effect. You get it. So double entry works a bit different. Of course, the same principle, because here we're trying to look at the end result. Cash is now moved to 200,000. Inventory is now 100,000. Here we're trying to look at the effect. Inventory has been affected by 100,000, which is a debit, like an increase in inventory. Cash has been affected by 100,000, which is a reduction. And that's why we have credited our cash. And that's the same thing here when we are trying to transfer transactions to our cash account here, we still record 100,000 because that is the effect of the 100,000. So that when we balance off this account at the end of the day, in case any other transaction happens in this account, you get to realize that we are going to have a balance brought down of 200,000. Sarah?
I
is
get
that-
it, sir. I get it. I get it. It's clear.
Okay. Okay, fine. Thank you. Thank you. So that's the principle. So the same thing also is very similar also when it comes to the rent. Rent, we are saying that rent is being affected by 50,000, and the cash that we are using to pay is also being affected by 50,000. So in the same way, if I'm to move, I'll open up a rent account and put this 50,000 on the debit side. And here in my cash account, I'll just come and record rent on the credit side of 50,000. That is what I would basically record, because that is the effect of the transaction. When I move to goods sold on credit, I say that this transaction brings about what we call debtors or accounts receivable. So this transaction, we are going to debit our debtors account, which is also called accounts receivable. As we proceed, you'll realize that we shall use the word accounts receivable very often. And we're going to affect this with how much? With the value of the transaction, which is 350,000. And what is the alternative account we're supposed to affect? Jen sold. So we have sales. Whenever sales are increasing, we credit them. So sales are being affected by 350,000. That is what is happening. And then Jen took a loan of 10 million from the bank to be paid in 3 years. What do we do here? We debit our bank since our account is going to be credited. Now, when I say credited, the bank credits our account. But for us in our books, we debit our bank. Whenever money is increasing now in our accounts, like in our books, we debit them. So we shall debit bank with 10 million. And we are going to credit what? We are going to credit our loan because it's a liability of 10 million. Like that. So that's how the transaction is going to be. So I'll open up a bank account and put this on the debit side. I'll open up a loan account and put this on the credit side. Any question? Any questions to those that are watching this live? In case you're watching this, maybe a recording of this, you can be able to share this question in the next class and I'll be able to answer it. But those that are watching this live, do we have any question up to now? So if I don't get any response, I'll assume that everything is okay. And at this point in time, again, I want to open the platform to ask if, apart from what I have shared with you today, from what you have gone through in the previous recordings, do you have any question or do you have any challenge that you would like to me to address before we end this lecture? So again, after this class, I'm going to share with you the videos that you'll be going through within the week. Like I said, we have a very limited time, so we're going to run very fast in September. My goal was to have you go through 2 topics in a week, and I request that you create time because I usually tell my students that passing financial accounting is not just about knowledge alone, but it's also practice. If we are done with a lecture like this, if you have a question that you can easily go through that is very similar to this, to acquaint yourself with the knowledge and understanding of what we have done, it's very good. Because practice is very key. You also need to practice and improve on your speed. Most students fail this paper not because they don't know, but because they can't finish in the exam. By the time my students are done with the classes, they have the knowledge. But what sometimes lets them down is the speed, being able to finish in the exam. So that is also one of the key things that I want us to work on as we proceed with as we understand the dynamics in terms of different topics, to get to an extent where we now can attempt examination questions, like the what I'd shared earlier on here. We'll be able to tackle some of these questions so that you can get yourself much ready for the exam. Okay, yeah. So that's very, very important. And I'm hoping that in this class, I don't have any students for September. But in case you're doing exam in September and you're part of this call, please reach out to me so we can see how to help you accordingly. So I believe that this class is specifically for December. Okay. Any questions? Any questions? Okay, so we don't have any question for now. It's just a few minutes to the end of the hour. I'm going to call this class to an end. And to those that had internet challenges in this, I'll try to drop the recording to you, and then we can be able to pick it up from there. Like you've seen, make sure as you go through the videos, get your notebook, write down some of these things. In case you have a challenge, note it down, so that whenever we have a chance to meet like the one we've had today, we can be able to go through some of your challenges. I'm able to expound. The reason why I do like this is I don't want to, I want us to move very fast. So I want to use these classes not to go through a topic which you have the recording for. I want you to go through the recording, so that when you come here, we do a clarification. And also the good thing with the recordings is that you can even forward back and re-listen to the explanation that I'm giving. You don't have to follow through as if it's a live class. You can be able to go back 5 minutes, see how the number has been computed, then you proceed when you've understood. Whenever we come here, it's also very good for you to be specific on what area you have a challenge to, so that can also help me to expound more on where you got a challenge. So thank you so much for joining in. And I believe that this has been helpful to each one of you. Let's meet next time. Bye-bye.